of the post-CPCC update, China Alpha Roadmap for 2023. We have an incredible lineup tonight. A keynote presentation from our leading economists from Grow, followed by a thrilling panel discussion about the opening markets onshore, alpha strategies, appropriately titled The Uncomfortable and Making the Uncomfortable Case for China Outperformance in 2023. First up, please welcome Mr.洪灏, Chief Economist of Grow Investment Group. He'll be sharing his top-down view of U.S. inflation, how we might be at a turning point, and more importantly, the future depends on the U.S. and China and their dynamics. Hao, I know it's your Friday, so thank you for joining us. You have the floor. Sorry, Hao, you might be on mute. Hao, are you with us? There we go. I think he's just setting up the slides. Sorry, and just 1 second. We just have a bit of technical difficulty. Just want to check if Hao's microphone is working. In the meantime, those of you who are just joining us, there is a poll that we posted here. Please do feel free to answer the questions. We'll be checking out the results of those answers, really taking a temperature of where we are with China appetite and the type of exposure you think we should be taking on in the new year. Okay, it looks like Hao is going to just restart his system and rejoin us in a second. Sorry, just give us 2 minutes, guys. Great, I see洪灏rejoin us here. Let's just give him 1 minute. Thank you, everyone. Those of you who are just joining, I see a couple of you are coming in. Thank you so much. I know it's late for those of you who are in Asia, and early for those of you dialing in from the US. And we're also welcoming those who are coming to us from Europe. Hi, Hao, can you say something?
Yeah, can you hear me?
Yes, we can hear you just fine. Thanks, Hao.
Okay.
If you're ready to share your slides, you have the floor.
All right, give me 1 second. There seems to be a bit of delay between us for some reason. All right, let's see. Okay, thanks, Alvin, and also thanks everyone's patience, for me to resetting up my computer. Let me jump straight to the topic tonight. Basically, tomorrow will be the day when we announce the all-important list for the 7th standing member of the Politburo of China. So that is probably one of the biggest events in Chinese modern history. Because right now we're selecting a leader probably for the next decade. and more. So, who's in, who's out, who's doing what, is going to be a key decision for the next decade. And obviously, the market is very nervous. For the past week, for this week, and also for the past week, even though the Hong Kong market is extremely oversold, we're not seeing a lot of buying from the market. Basically, the trading volume has shrunk dramatically. But then at the same time, we're seeing long fund liquidating the position in China. 2 days ago, there was a fund dumping $500 million worth of Chinese ADRs on market in the day. So that caused tremendous pain in the Chinese space, especially in the Chinese ADRs. So obviously, besides what's going on in China, the dynamics between China and the US is also playing an increasingly important role to determine where the market is heading. And obviously, right now, the market doesn't have too much confidence in the direction going forward. But let me go through some key economic variables that we look at. And these are the variables, or these are the less discussed relationship in the marketplace. And I believe that maybe not all of these relationships have been priced in the market price. So firstly, let's look at the US inflation situation. And the outlook of US inflation would determine where the Fed's monetary policy is going to be for the coming quarters. Basically, we're looking at some leading indicators, such as the NFIB job hard to find, job hard to fill index. And obviously, the blue line, which is the job hard to find index, hard to fill index, the lower the index is, the easier to fill a job. All right, so, and normally this blue line, the job hard to fill index, tend to lead the CPI by about 6 months. All right, so we're seeing a dramatic decrease in difficulty of people finding a suitable applicants for the job. And if we are seeing a collapse in the difficulties in looking for applicants, therefore, then in the coming quarters, if historical relationship continues to hold, then we should see the US CPI coming down as well. And I believe that this is why beyond the immediate 2 quarters, we're seeing the US Treasury futures increasingly pricing in a Fed pivot. But then at the same time, we wouldn't be jumping for joy if that happened. If that happened, if inflation does collapse, it actually means that the demand in the US collapse as well, and it has a tremendous implication for China. Now, as you can see, this year, what is holding the Chinese economy up is exports, right? So exports has been going from strength to strength for the past 2 years. It's actually one of the few shining spots remaining in the Chinese economy. All right, so this year, even though year-on-year Chinese export growth has been slowing down, it is still growing at about 8 to 10% per month, and also it's translating into huge trade surplus for China. All right, so just imagine, right? So if the U.S. demand slows down, therefore the demand, which China is a major supplier of U.S. demand, is also slowing down. So Chinese exports consequently will slow down as well. So therefore, as you can see, then the Chinese economy would be in a pretty difficult situation. All right. So one shouldn't be too surprised to see that happen. All right, in the coming 2 quarters. So when that happens, right? So just imagine China doesn't have the export leg to support its economy. Property sector is still ailing. The fiscal expenditure is being limited by government debt and also by local governments' huge fiscal deficit, because they couldn't have enough land sales proceeds this year to refill the budget deficit. Just imagine what that happened. Right. So then, and also, another key issues that is in people's mind is the COVID-0 situation. A lot of people were hoping that, after the 20th Congress, we will relax the COVID-0 policy. Now, unfortunately, that didn't happen. All right. So I think, people have a sort of a misplaced belief in how the Chinese culture approach, problems such as this. Right. So because the senior population in China, it is still 60%, around 60% vaccinated. So, if there are some unforeseen uncertainties about this virus, then it will make the senior population in China very vulnerable. So obviously the Chinese leaders won't let that happen. So as a result, China tend to approach critical issues with a gradualism. So we wouldn't, switch the on and off switch overnight, but gradually we should adopt a gradual approach and also gradually open up the Chinese space. And so therefore, the most likely time to be sort of moving towards that direction is probably after March next year, in 2023, when the twin sessions finished in March. So then that way, the reopening is later than what most people were believing. But is that a really bad thing? So a lot of people seems to think that, COVID-0 has impacted the Chinese economy in a huge way. I sort of cannot completely agree with that opinion. Basically, one has to reconcile between very strong Chinese export and also very restrictive COVID-0 policy. If COVID-0 policy is limiting the production capacity, then, who is producing all the exports? Who is supplying the US demand with all the exports? Right. So it just doesn't add up. And also there's a reason, besides the reason of protecting the senior population, there's another reason why China wants to sort of adopt a restrictive COVID-0 policy and also, adopt a gradual approach towards reopening. Now, because, manufacturing and also exports is, one of the bright spots remaining for the Chinese economy. I mean, just imagine when you reopen the entire economy and then the virus have unexpected consequence and then started to affect your manufacturing base and start to impair your manufacturing facilities and capacities. Then that way, really, then it will make the Chinese economy even more difficult than it is right now. All right. So this is probably one of the strongest reason that I can think of to stick to the COVID-0 policy for now. But in recent days, though, there are some early signs of relaxing the COVID-0 policy. For example, I'm sure you've heard of the discussion about 2+5 instead of 7+3 quarantine for foreigners coming into China. And also, the Chinese airlines are reopening the international routes with some Asian countries. But just, keep in mind that even so, the reopening flight capacity is about 5% of 2019, right? So it's very small, but we will say it is the one sort of a step towards the right direction. And because of that, all right, so because of the diverging Chinese and US monetary policy, undoubtedly it's putting a lot of pressure on the Chinese yuan. All right, but having said that, the Chinese yuan is still one of the best performing emerging market currency against the US dollar. I mean, even if you consider the euro, the pound, the yen, the Chinese yuan this year is actually depreciated far less than many of its trading partners. So if you look at how the yuan sort of moved over the past 20 years, you can see that it has a very close correlation with forex reserve and forex deposits in Chinese commercial banking system. Right, so the yellow line. So you can see almost like a one-to-one correlation between these two variables. Now, the funny thing this year, if you think about it, right, the funny thing this year is that the exports has been going from strength to strength, but the Chinese yuan is still depreciated. Right, so it is very strange, but this chart sort of explains to you why that happened. Basically, even though the Chinese yuan, the exports has been going very strong, but foreign reserve and also forex deposits in the banking system didn't increase much. And on a year-on-year basis, it's actually decreasing. It's very, very odd. And so because of that, and also because of the divergence between the Chinese and US monetary policy, it's putting undue pressure on the Chinese yuan. So another way to look at it, is trying to see or another potential variables that we should look out for, to determine where the Chinese market is going, is by looking at the Chinese shadow currency exchange rate. So basically, we can simply use Chinese M2, which is about 250 trillion yuan, divided by the forex reserve, which is about by today's exchange rate, it's about 30 trillion yuan. All right, so 250 divided by 30 is about 8. Okay, so 8 to 1 US dollars. So as you can see, over the past almost 30 years now, the shadow currency exchange rate goes almost hand in hand with the US dollar index. So by now, by the simple calculation I offered just now, right? So 250 trillion M2 divided by 30 trillion forex reserve, you get a ratio of 8, and now the Chinese yuan is about 7.3. So theoretically, you could see the Chinese yuan, breaking out to 7.8 or even 8 and above. So that is a theoretical valuation of the Chinese yuan. But having said that, you can see that on this chart, it almost never happened, right? So since 2001, China entered the WTO till now, the shadow currency exchange rate never really go beyond 8 that much, right? So I think the highest that we have ever went to is about 8.2. So right now we're at about 7.3. So to me, the pressure is still on, and I think the PBOC will try very hard to defend the currency. And also weaker currency is actually helping the Chinese exporters, right? So even this year, export growth slowed down. They're still making heaps of money because almost all Chinese exports are priced in US dollars. Right. Another way to look at it is look at the yuan's valuation cycle. If we put on a 3.5-year moving average on the Chinese yuan currency movements, and you can see that, right? So at every time at the intersection where the Chinese yuan cross this moving average, something very important happened, right? So if you look at, for example, 1990, you have the economic hardship, right? So that is after the period of very high inflation. So then there is a one-off jump in the yuan depreciation back in the 1990. And then in 1993, there's a currency reform. So in one step, the Chinese yuan depreciated from 5.5 to 8. Okay, this is huge. And then 2005, there's a currency reform again, and that is for the yuan to appreciate. And then it goes all the way to 2015, another Chinese currency reform. And that went from 6 to 7 to 7.3, blah. So, it is a very interesting chart. The cyclical feature of the Chinese yuan is very vivid on this chart. And right now, because once again, we crossed this cyclical line, the moving average. And therefore, to me, potentially the yuan can depreciate much further from here. It really depends on how the PBOC is going to manage it, to manage the yuan currency depreciation. But, in recent days, the depreciation pressure has intensified. So another very important issue from the 20th Congress is about the Chinese property. Many must have read the news stories about how housing is for living in, not for speculation, is actually not mentioned during the speech of President Xi. But this term is actually still written in the draft of the speech. So there are a lot of guesses, why this had happened. Many people were saying that, maybe the housing is not for living in, is not emphasized anymore. But to me, it reflects that there's a huge debate going on in the party. Now, basically, there's one part of the party that is very adamant to use property sector again to rescue the slowing Chinese economy. But then Mr. Xi, who championed the term house is for living, not for speculation, he probably, stick to his mantra, and he has a point, right? Because the property price is very expensive in China. So, then that way, in order to compromise, right? So we write it into our speech, but we don't mention it during our speech, right? So that is a nice way to reach a compromised agreement between, the other section within the party. So as you can see, since 2019, the relationship between Chinese property and also the overall Chinese stock market has changed to an inverse correlation. Now, before 2019, basically, whenever the Chinese property did well, then it means that the stock market tended to do well as well, right? But not until 2019, the relationship between stocks and property flipped. And also in 2021, China proposed a 3 red line policy, so limit how much loan the commercial banking industry can lend to property developers. It limits how property developers can use leverage to buy land, and also limit the leverage that property developers can have on their balance sheet. It was huge. So ever since then, you can see a very prominent inverse correlation between these two variables. So by now, if people think that China is trying to rescue its property sector, then it actually doesn't translate into a very strong stock market. So let's look at how the market is trading right now. So this would be the last few charts that I'll be sharing with you tonight due to time limitation. Now, firstly, let's look at how oversold the Hong Kong market is right now. Right, so the yellow line is, the number, the members, the number of constituents of the Hang Seng Index that is above 200-day moving average. Right, so right now it's actually one of the lowest in the past 20 years. Right, so it's as low as 2020 during the COVID. It is almost as low as 2016 after the Chinese bubble burst, and also almost as low as 2008 as well. So pretty soon, you will see all the index member below 2,000-day moving average, 200-day moving average. And also in terms of China CDS spread is on the rise as well. I think it's a reflection of a weaker currency and also a reflection of the US dollar strength. But as you can see, even though the CDS spread is surging, it is still not as high as what it was in 2015 and also in 2011. When there was the US credit rate, a sovereign credit rating downgrade. So potentially it can go much further from here. Given the situation that we're facing, and also the top down PE, which is the dotted blue line, it is very low. It is very, very cheap, but it's not the cheapest in history. So it can go lower from here. Last chart, is the offshore Chinese US dollar high yield bond. Right? So as you can see, there's a huge collapse going on there. In recent days, many of the names, not just the property names, many of the Chinese tech names, right? So Tencent, Alibaba, they all have long-term outstanding bonds, right? So many of these bonds is being sold down aggressively as well. So from peak to now, many of these bonds are down almost 50%, right? So it's seem to be whole. Right, so to sum it up, China is going through leadership change. The leadership selection is going to determine the direction where China is going to move in the next 20 years, in the next 10 years. Because of that, the Chinese economy is suffering from some uncertainties, and that is reflecting in Chinese currency. And also the PBOC is trying to use monetary policy again to help. But, so far it is not very effective because the Chinese property sector is still being limited by 3 red line. So the market obviously is in panic. High yield US dollar bond is being sold. The Hang Seng valuation is very cheap. And the currency is also has further room to depreciate as well. So I'm sure that everyone is waiting to see what tomorrow's list will bring, and let us hope that once that uncertainty settles, the market can refocus on fundamentals and move forward. I'll stop here and hand back to Alvin. Hi, Alvin. I'm handing back the floor to you.
Sorry, everyone. My computer just crashed, so I just had to switch over to my mobile. So bear with me. But yes, thank you so much, Hao. That was an incredibly insightful, albeit tough. But as the purpose of this next panel is really about finding opportunities, especially when we're in the deep of the FUD, the fear, uncertainty, and doubt. So I couldn't be more excited about today's panel. For those of us who are already based here in Hong Kong and Shanghai, we are privy to a dialogue with both onshore managers, regulators, and offshore investors, interpreting the appetite from both sides. While there are clearly geopolitical risks, as allocators, we still have a responsibility to deploy capital, and even more so as advisors to global investors who are focused on alpha generation. So it's during these periods, we actually get we get the most excited in a way. Joining us tonight is SDIC Essence Shanghai's General Manager, Ms. Fei Liu, Director of RCM Alternatives and Head of China, Mr. Matt Bradford, and finally, of course, the CIO and founder of Grow Investment Group, Mr. William Ma. Welcome, everyone. Okay, so we only have about 40 minutes on the clock, so let's begin. You have there the poll in terms of the appetite, William. You probably can sort of have it checked there. Help us read the tea leaves a bit here, and not just from the speech, but also from the overall communication coming from the regulators over the last quarter and recently. Markets looking bad, but they're not exactly sitting on their hands. Looking past at the deleveraging policies from regulators over the last quarter, which sectors and industries should we start to look at in this phase of the cycle?
Thanks, Alvin. I think the interesting part about the poll, if you like, is half people are positive, half people are negative. So it's kind of like a half cup full, half cup, empty situation, which means, opportunity for active and hedge fund manager. To put some number into perspective, I think, China, as Hao mentioned earlier, in particular, the Hong Kong market is trading at very, undemanding valuation. And for example, the China-Asia market now, we are trading at 9 times price to earnings versus Asia-Pacific, 11 times. But in terms of EPS growth, in China, we are looking at 9.5%, EPS growth versus rest of the Asia, about 6%. So I think fundamental and valuation is attractive, but what we need is catalyst. And back to your question, Alvin, I think the key two words, what we get from the Party Congress is one, development. I think we are ensuring that, China continue to develop, on different areas. And second is about, unemployment. So I think there will be more policy supporting, this two kind of like initiative. So in that regard, I think there are 3 sectors that we are seeing more positive kind of like themes. In particular, we are seeing some hedge fund manager increasing the exposure as well. The first one is domestic consumption. I believe, the inflation in China is not very high, which, kind of like create a good background or backdrop for the Chinese government to continue to push consumption by, tax cuts, subsidies, and also to create employment in the service, sector, if you like. So we are relatively positive on the domestic consumption on the consumer staple side. If you look at some of the beverage company, actually their stock price and earnings is quite stable. And some of the subsector for consumer staple is kind of like white goods manufacturer. We are seeing, price increase despite the volume is down and earnings is going up as well. So those are some of the niche sector that we should look for. The second one is policy support. For example, the electric vehicle type, new energy type. We believe there will be more policy support, in this sector as well. The last one is about development, which is the high-end manufacturing. So we believe there will be more kind of like support, subsidy or policy, on the make in China or high-end manufacturing sector in the medium to long term. So those 3 sectors, we are seeing, positive, catalyst, from the Party Congress, Alvin.
Thanks for that. I want to pivot here over to Matt, who's coming from the U.S. We all know there's issues here, and maybe William can pipe in as well. When we speak to investors and allocators that come from the U.S., it's obviously there's a lot going on. It's quite bearish. But how do we give them insight on what is clearly a very negative sentiments, particularly around the property market, high youth unemployment, and their severity? You kind of quoted a few points there, but how do you position it for investors who are still a bit skittish, but still curious as well? As you pointed out, we're very oversold.
Right. I think you need to ignore the noise. I mean, there's a saying, you look at, the best house in the worst neighborhood. So although it may be dismal in China, is it worse elsewhere? William pointed out inflation being low in China. There's a different story in the United States. And for the traders that I deal with and hedge fund managers, volatility is not a bad thing. So really just looking at volatility, directional volatility, the market's moving in both directions, is what, the strategies that I deal with strive for. And, I can only speak to hedge fund managers and CTAs that are trading commodities and indices. I'll defer to William being the expert in terms of looking exactly through the tea leaves in terms of what the trends are and how you can capitalize it in mainland China.
Yeah, William, what do you think about that? I mean, Matt raised a really good point. Things aren't so great elsewhere either. There was just a $1.5 trillion margin call on the energy sector. Winter's coming in Europe as well. It seems U.S. is still on the precipice of a recession. But you know what? This is the type of environment where traders and alpha generators really start to shine. So, what are your thoughts on where we need to see regulation go?
Yeah, I think, no news is good news, or, no catalyst is good catalyst. We are actually seeing a peak of, short interest in the Hong Kong market, if you like. So I think a lot of people are kind of like putting negative bet. But if there are certain kind of like positive catalysts or, kind of like recovery of the economic figure in October and November, I think that will squeeze out the short squeeze part. So I think as active manager and hedge fund, those are things to watch out, or they would be positioned. Again, I think we need earnings. We need fundamental to be improving. From my perspective, I think we've passed the worst time, if you like, and, relaxation of the property market. We just need a quarter or two to see things, kind of like turning better. But again, you want to position yourself, ahead of, those, no news is good news situation.
Yeah, I couldn't agree more. Having said this, though, China, actually, the regulators started opening up the markets just about a month ago, in fact. Back in the day, we've been waiting, 3 years now for the QFII regime to open up. I'm going to pivot over to Fei. Some of the most exciting news this quarter was, in fact, that QFII, the expansion of the QFII rules. 45 instruments out of the 101 available on the market are now open to foreign investors. It's actually very exciting. A lot of the CTA managers that we speak to offshore are very excited to get access. Maybe you can tell us a little bit more about the opportunity set here for foreign investors and share with us maybe some statistics about the market depth.
Yeah, sure. Thank you, Alvin. So as most of you already know, Chinese regulators and exchanges have jointly announced that starting September 2nd, QFII participants are officially approved to trade onshore commodity futures and options. And so it is a very exciting news, which we all have been waiting for years. And the message is clear. The opening up of China's futures market is accelerating. I do have some stats for commodity futures. So according to China Futures Association in 2021, China is the largest commodity market in the world. And foreign participation in commodity futures is about 10% of total market. In our own analysis, in terms of trading volume, China's derivative market is about 45 to 50% of Asia's market, and it's about 15 to 20% of global market. And in the latest stats published by FIA in terms of global exchange volume ranking, Dalian Commodity Exchange ranked the 8th, Zhengzhou Commodity Exchange ranked the 10th, and Shanghai Futures Exchange ranked the 12th. So let's take SC crude oil as example. This contract listed on SHFE and was the first contract open to overseas investors. In 2021, the market size of SC crude oil contract is second only to Brent and WTI. As for foreign participation on this contract, it accounts for 25% of total market. And this contract is only about 4 years old. I mean, on one hand, it demonstrates a very high correlation with Brent and WTI. On the other hand, it has also shown some independence in price fluctuation. So in short, I would say the opening up of China market is an ongoing case, and there's still so much potential to grow.
That's awesome. I think that one stat in there about 10% foreign participation in the onshore market, which, as you mentioned, is one of the largest, if not the largest, commodities market, is very appetizing for offshore portfolio managers looking to diversify or looking for some exposure that's I think is clearly in many ways uncorrelated to the other strategies. When you look at the 45 new instruments, do you see any particular interest for foreign investors? Now, we know that there's quite a bit of active participation in the internationalized contracts. When we look at the new ones, which one stands out for you, for your clients?
Well, apart from crude oil contract, which we just mentioned, there's copper, there's rubber, iron ore, and soybean oil. I mean, some of these commodity prices are increasingly driven by the price action in China. And soon enough, you will find this carbon emission futures and freight futures. I mean, those haven't been launched yet, but still have gained lots of tractions. Let's take copper as an example. So copper is another product of common interest among overseas investors. And there are three major copper futures market globally: LME, CME, and SHFE. So according to FIA in 2021, CU copper futures on SHFE ranked the first in the world by trading volume. At the same time, SHFE copper also serves as a proxy for China's macroeconomy. So before September this year, overseas investors can only access BU copper futures on INE, which is another copper future contract with lower trading volume and different contract dynamics. But now, in the new era of QV, overseas investors can also engage in both CU copper futures and options on SHFE, which is the largest market. And meanwhile, foreign participation in domestic iron ore futures also continue to rise. China has the largest iron ore consumption and is the largest importer in the world. So with China's continuous effort in being a price maker instead of a price taker on iron ore, we have seen many global miners and international trading houses have been more and more involved in domestic iron ore futures to carry out hedging as the new channel to protect the mining and sales profits.
That's fascinating. Matt, I'm going to bounce over to you because this is very interesting. We have some amazing stats here with the onshore market as it opens up. RCM works really closely currently in China onshore and with offshore allocators in the international markets and in the CTA space. Matt, you're no tourist to China at all, of course. So your team is a bit more familiar than most allocators that we know. From a trading perspective, what are the differences that you see between onshore and offshore markets that we need to pay attention to as they open up?
Yeah, great question. There's so many nuances that make China just an entirely different animal. Let me just spit off a few, and it's certainly been a learning curve, but, we've had boots on the ground in trading China for the last 5 years. So, you have to tag orders. And again, I'm speaking specifically to futures, which is relevant with this new QFII regime. You have to tag orders if you're opening or closing. You can be on both sides of the market. So in other words, you're not even flat. You may not have exposure, but you could be long corn, short corn, same contract. There's not span margin like there is in European and US exchanges, where if you're long and short, you're effectively double margined. There's 2 1-week holidays in China where the market closes for a week, so you need to pay close attention to that. The exchanges increase margins leading up to that, so you need to be cognizant. Generally, a lot happens during a holiday, so you can expect gap opens, against you or in your favor. There's an overnight session in China that some of the commodities are more liquid than the day session, which is not unexpected, without trading. There's tea breaks, so there's breaks during the day. 2 of those. You're not able to execute spreads, so you're legging spreads. So you have, you potentially give up edge on both sides. There's a massive retail component versus, institutional players, which I think will change. It was interesting that Faye pointed out that foreign participation is only 10%, which leads me to believe we're in early days and these markets will become much more efficient, in the quarters and years to come. What is not expected or wasn't expected for some of the traders that we work is, while there are crude oil contracts and copper contracts and gold and silver contracts that trade on other exchanges, they're not perfectly correlated. So there's definitely an arbitrage opportunity where, I wouldn't say there's inverse relationships, but they're not always moving lockstep with other exchanges on, globally, which is very, very interesting, from a trading perspective. High level, I think those are the biggest trading nuances from a futures perspective.
From a regulatory perspective, there's always, and you and I both appreciate this, there's a stigma that onshore regulators are frequently intervening in the market. In your experience, is this true? Do foreign investors need to adjust their strategy materially for onshore regulation?
I don't know that they need to adjust it, but they need to know what the rules are and they need to play by the rules. The regulation to me is a good thing, and they're really leveling the playing field. We're all playing by the same rules. So if you have, let's say you're a small emerging manager and you have 5 or 10 million USD equivalent, or you're, a large player, kind of levels the playing field. You just need to know what the rules are. And the approach we've taken is, we're collaborating with local talent, mainland talent. We're finding firms that have a global vision, and we're trying to find trusted partners. There's no instant gratification in China. Us building our business, it's taken way longer than one would anticipate. It's cost way more money than one would anticipate. But we're starting to our hard work's starting to pay off. So really, the regulation, some view as a negative, I view it as a positive.
Yeah, and just for those who are first to meet RCM, some of their onshore strategies working with the local partners have had outsized returns in the CTA market. So congratulations on that, Matt. I want to switch over just a little bit back to Faye. I mean, we talked a little bit about foreign investors in PRC. Just before I dive into alpha discussions, could you maybe just brief us on what the breakdown is between the types of foreign investors who are coming in? Are these like the Glencores, or are there other types of institutionals and FIs playing in the space now? This is kind of an interesting question because, as we mentioned earlier, it's very retail in terms of its behavioral pattern. And a lot of investors are wondering, how much time will it take before we not crowd out the trade, but increase the efficiency in the market there with respect to offshore?
Yeah, actually, foreign investors have been engaged in China futures market for almost 2 decades, and commercial companies such as the ones you just mentioned, Glencore, this Cargill, Trafigura, and etc. They came in and they set up WOFE and joint venture, and they built onshore factories. And these commercial giants have been trading onshore futures for ages to hedge their physical exposure. With China's getting more and more involved in the global economy, the exchanges have introduced several internationalized futures contracts for those who doesn't have WOFE or joint venture or even QFII qualifications. So we can see mostly these commercial companies engage in onshore futures trading through internationalized futures contract, as these contracts support physical delivery. On the other hand, QFII is most popular among financial institutions. QFII investor can either trade directly via QFII, or they can use QFII to invest in onshore funds. So till today, there are 723 QFIIs, of which more than 60% were from Hong Kong, US, and Singapore. And most of them are financial institutions, including banks, hedge funds, there's public funds, trusts, asset management firms, and security companies. In the past, QFII was only allowed to participate in stock index futures and was limited to hedging only. Now, the new QFII regulations have reduced the application threshold and expanded the scope of trading to commodities. We should expect more foreign QFII participants coming from non-financial institutions background, such as commercial and industrial companies, and also more foreign CTA traders coming in with their advanced strategies.
I want to come back to CTA and advanced strategies in a second, Faye. William, Matt, I want to talk a bit about alpha. Our investors are neither excited about the large caps, even though they're oversold. There's about 20,000 registered hedge fund and private equity managers onshore. There's a split of roughly 50-50 on private and public equity. So my question is to you, maybe William, you can take this first, is what strategies are you seeing perform well in 2022? And more importantly, let's look forward into 2023, how you'd be advising your offshore investors for the next 6 to 12 months.
Yeah, sure, Alvin. I've been, investing in Asia and China hedge fund for almost 20 years, starting when I was like 3 years old. So, so actually there are a lot of, alpha opportunity. I think besides the beta opportunity we talk about in terms of alpha, I'll share 2 real cases with you. The first one is about 4 years ago, one of the largest US pension fund asked me to bring them to see 6 domestic China macro and CTA manager, and they were interested in 2. They told me that they did a correlation analysis out of their existing 10 billion, CTA portfolio. And then they find out the negative correlation of those 2 managers, and then they want to put a ticket. So the alpha opportunity has been very obvious, starting 4 years ago, but we are seeing it coming back again. We are seeing an RFP from some of them. And then the second real case is about 6 months ago, one of the largest Singapore pension fund asked us to do an analysis of the domestic China CTA and CP, fund, as convertible bond fund with them. And the correlation over the last 7 years for the China CTA with the global hedge fund index is negative, 0.04. For the CB, index is 0.07. And both of the strategies yielding mid-teens type of return. And the third real case is, Q3 this year. The China Asia market was down 15%, in Q3. But, CTA and CB, for example, some of the strategy that we're investing is actually ranged from down 2 to up 2%. So I think that is a hard figure supporting the alpha or the negative correlation with global and local manager. So the second point is, what we're excited, for next year, we believe CTA and convertible bond will continue to be doing well. And with some extent, China macro and some active trading manager, because our view and position is, next year is going to be an exciting year for the China Asia market. And besides CTA and convertible bond, we believe, some of the active manager can do well.
Yeah, I think a lot of us here, and forgive us for being, to the audience members, forgive us for being biased, but actively managed strategies is what we're all about. We've consistently seen actively managed strategies do well in this type of environment. The passive strategies over the last 18 months have gotten pretty decimated. And so we're definitely excited, and especially for those managers that we've met who were savvy enough to keep some dry powder on the side. This is a very, very interesting market to move into. Matt, what are you seeing from your end in terms of the managers that you've been working with from a performance level? I dare say some of them are even in double digit, but I'll let you brief us there.
Yeah, no, I'm excited to hear that, William thinks CTA is going to be positive in 23. That's music to my ears. I think a lot of it from an investor perspective and a manager perspective, what makes CTAs attractive in China is, one, there's a lot of markets that don't trade anywhere else on the globe. So, it makes sense for that negative correlation because you're getting alpha that you can't get elsewhere. And, these institutions and even these big managers globally can access China and expand their capacity because, again, they're the non-correlation in the market. So it's really beneficial to both the investor and the manager. So speaking, from my lens, I'm drilling down on CTAs and, you're right. A lot of these strategies have performed. The fundamental strategies, believe it or not, are performing. Looking at some of the strategies that I track, best performer fundamental strategies up, 30%, max drawdown, 10%. A lot of these strategies that I track have an annualized volatility around 10%.
Wow.
The most strategies in terms of subsector I see are market neutral strategies. They're performing. The fundamental stock strategies in 22 have not. I mean, the 20 strategies that I looked at here yesterday when I was just perusing database, only 1 out of 20 strategies was positive for the year. My experience, I have a fundamental strategy that's been live for a couple of years, 100% systematic. That's performing. We're launching an ARB strategy that we've been setting up the infrastructure for, it seems like forever. That's going to go live here in the next couple months. Intraday high frequency strategies that we track. We're going to launch one of those Monday next week. And then we have 2 strategies that we consult with that are mid to short-term strategies. They're relatively flat this year. I mean, up a couple percentage points, down a couple percentage points. Multi-strat index have performed. I mean, unless you're long equity in China, I mean, there's mixed results, but most of these alpha strategies are performing. To me, as an allocator, the most critical thing for me is not only do you perform, but do you manage risk? So I'm really keen on what the risk-adjusted returns look like.
Yeah, I think the culture of risk is something that you definitely need to bring to the table. The days of relying on the long view that fundamentals will eventually express themselves in the market is not really working out this year. And I would agree. A lot of the ARB and the market neutral strategies are really shining in especially in the CTA space. So on that note, when it comes to the QFII regime, which I think you and I were actually working on, helping offshore investors bridge that gap. What are we doing different here than I guess what some of the traditional avenues are?
It's a great question. I mean, again, I think it boils down to, and I know at the risk of sounding redundant, is just finding local partners and dig and get multiple opinions. Because it seems like the more people you talk to, you get different perspectives. And, the appetite is so great from a Western investor perspective and a Western manager perspective to access China. But it's just so different. So I don't know that we're doing anything differently. You just need to be patient and, just keep asking questions. Ask questions from local counsel. Ask questions from several different prime brokers, legal. Yeah. Talk to the exchanges. Talk to local domestic traders. Just get as many opinions as you can.
Yeah, man. I think you really point in summary. We can't be a tourist about it. If we're going to do this, we have to take it seriously. But the alpha is there for the taking. We just have to put in the time. On that note, Faye, I wanted to ask you a little bit about algorithmic, more importantly, systematic strategies. There's actually a lot of it's hugely popular. We helped a few teams from Shanghai build their offshore business, which are systematic, algorithmic, quant in nature. With so many algo managers onshore, what's the role for offshore investors to compete in this space, you think?
The fact is, overseas algo trading firms, they have come into China market for more than a decade. They came in, they have WOFE and joint venture. Most of them were already highly successful in their home country. And they brought in their super weapon, which are their advanced strategies, hardware and technology. Over these years, they have created a huge impact on local algo trading firms. And they are definitely playing a leading role in the domestic markets. Actually, I'm glad that you brought this up because I do get this question pretty often. And my friends from overseas, my overseas clients, they always ask me, can we trade algo? Is there any rule against HFT? I think, sorry, Albert, I'm just going to take 2 more minutes to address this concern. I think there's a genuine misconception of Chinese regulators over algo trading. I mean, if you just look at what the law says, the futures and derivative law, which came into practice in August this year, it stipulates that no entity or individual shall manipulate the futures and derivative market. Manipulation, in this case, refers to price manipulation, volume manipulation, self-trading, spoofing, and so on. And the law also stipulates that those who place orders through program trading shall comply with the regulations and report to the exchange. So we have 2 requirements here, manipulation and reporting. So coming back to most of the question coming from overseas, can clients trade algo and should they be concerned? As long as you comply with these 2 requirements, you're fine. Your strategy is legit. And I actually have discussed this matter with one of my friends who works for an exchange onshore. And he told me there are basically 2 dimensions to gauge whether your strategy is legit strategy. Number 1, does the level of liquidity fit rightfully for the current status of China futures markets? Number 2, does the liquidity come with high degree of concentration? After all, no one would ever reject liquidity as long as it's legit. So there's definitely a huge space for overseas algo trading firms.
Yeah. And one thing I do recognize is that these rules are consistent whether you're onshore or offshore participants in the market.
Yeah, exactly.
Yeah, so it is a level playing field. I want to jump over to investor appetite, guys. Matt, William, this one's for you. When we look at the appetite for onshore managers versus offshore, global managers looking to access China internally, where do you see that? Where do you see that happening? Because we know a lot of onshore alpha drivers who are raising capital quite easily onshore, but there's a lot of potential allocators who could tap into offshore as well. But at the same time, offshore investors might be more comfortable with offshore managers who are accessing the market onshore. William, this is a nuanced one. You want to try this one first?
Yeah, actually, I think more global investors are seeing the benefit of investing in domestic onshore China manager directly, either with their own Q3 or, talk to people like you, me, and Matt about it, at least, reference check and checking the local guys. Because I think, numbers speak for itself. If you look at the performance, as I mentioned earlier, the domestic manager every year outperform the global people trading China, by 5 to 6%. And in particular, there are a certain batch of mid-sized manager that is unheard of, globally, but they are trading at very nimble, niche space, no matter CTA or convertible bond, capturing the local opportunity. And there are some structure alpha, Alvin, if I mention on the convertible bond, because the CB actually, they got, price refix mechanism in which some of the global players did not realize, is happening that way. So I think there are some structural alpha in terms of certain sub-strategy. We are seeing potential new opportunities like volatility trading, going to be happening in China as well. So those are really niche strategy that only onshore manager currently looking at. And that's why, the short answer on the global demand is since the Q3 is opening up, since those numbers are being reported, since there are more global service provider, like some of the global custodian and PB are setting up shops locally, I believe more global manager and tapping into the onshore China manager space.
Yeah, definitely. Matt, you want to pipe in here?
Yeah, I mean, I echo William's sentiment. I think the biggest challenge for me has been due diligence. You know, in 2018-19, pre-COVID, I was over there several times a year. I could meet these managers, tour around with them, do on-sites. You know, fortunately, I'm not saying COVID was a good thing, but, you know, what it allowed me to do not getting there was hire consultants. So have boots on the ground that can do the due diligence. But I think it's very important to meet people in person. You know, the deal terms are a lot different in China, so you have to get accustomed to that. Not necessarily say the structure is different, but what you're accustomed to in fees and transparency and, you know, management fees may be different. Incentive fees may be different. The, you know, commercials not only may be different, but the payouts. And one thing that I really, really like doing business in China is most of the strategies that I've dealt with, domestic that we've explored is, you know, the manager eats their own cooking. So, you know, that's very important for us that interests are aligned with the investors when the manager has, you know, his or her own money and capital at risk right alongside the investors.
You know, typically, how much does that look like? I mean, is there a number in terms of alignment of interest? Do at least 5%, 15% capital? Is there
Yeah, I mean, I think it varies strategy to strategy because some of these strategies, like the ARB strategy, we're looking at, you know, it's capacity constrained. So, you know, I don't necessarily want the trader to be their own biggest client because then, you know, it could be problematic. But the fact that they do have, you know, some of their own skin in the game, it checks the box and makes us feel a little bit more comfortable. But it varies, you know, strategy to strategy.
Yeah, absolutely. Well, thank you so much, guys. We are down to the last minute. So I wanted to thank William, Faye, Matt. You guys have been amazing. Ladies and gentlemen, this has been a thrilling session, even though it does look bearish. As you can see, those of us who are advising investors are very, very excited about the next 6 months to come. Long-term, still very bullish. And so long as we can cut through the noise and find the opportunities while everyone is fearful. On that note, there will be a replay of this event. Thank you for those of us who are joining from Tencent meeting, and for those of us who are joining from overseas. Thank you, everyone, and we'll talk to you soon.